For more, let's look on the latest market moves. Let's now welcome in Venu Krishna, Barclays head of U.S. equity strategy. Venu, is good to see you. So you raise your S&P 500 target for 2025 to 6,600. How come? Walk us through the drivers there.
Well, I think the core reasoning is that from a macro standpoint, we are very constructive on the market on two fronts. One, the virtuous cycle between income, employment, and consumption is extremely strong, and consumer balance sheets are in great shape. And second is the overall fact that the economy is doing quite well, right? And especially if you look at the technology sector, it is humming. So when you put those things together at the core, we remain quite constructive about next year.
And Venu, it's interesting that you mentioned technology, right? Because there's been this whole narrative about broadening out of at least stock returns for what we've seen in the market. And indeed, that's been borne out by the Russell 2000 doing better, the S&P equal weight doing better. But you also look at earnings growth for tech, and you say maybe the market is underestimating the amount of tech earnings per share growth we're going to continue to see. And in fact, you had a chart looking at the large cap tech versus the other companies in the S&P 500.
Yeah, I mean, I agree with you 100%. I think what is happening right now in our perspective, and this is what we've said for quite some time now, that the market is on a consistent basis underestimating the earnings power of tech, especially big tech. At the same time, it is systematically overestimating the earnings power of the rest of S&P outside of tech, right? And so this quarter is a great example of that. The expectation going into this quarter was for big tech to have flat earnings. Have earnings up 19% year over year, but their revisions were kind of flat. For the rest of S&P, the numbers are actually marked down 2% going into earnings. What happened when we're pretty much done with earnings? Instead of 19%, big tech as a group delivers 31% of earnings growth. And the rest of S&P, it moves in the right direction, but incrementally. So instead of minus 2%, it's plus 2%. So the point is the rate at which tech earnings are expected to decelerate is going at a slower pace than what the market expects. At the same time, the rate at which the market expects the rest of S&P's earnings go to accelerate is also much slower. So this so-called convergence, which the market was factoring in to happen in Q1 of next year, has got pushed back to Q1 of 26.
So what does that then imply about the rate of returns, right? Because accompanying that narrative about convergence has been the narrative that the rally needs to broaden in order to continue.
Yeah.
But it sounds like from what you're saying, it doesn't necessarily.
It will converge, but at a much slower pace. So directionally, I think the good news is we are going in that right direction. And so for tech, if you look at the problem is, or the challenge is, that their comps are very tough. So Q3, Q4, they were posting 60% plus growth. So that's what you're looking at now. But for the rest of S&P, they bottomed 2 quarters after big tech. So their comps actually are easier. So for them to meet the numbers are reasonable, right? So, but the scale in general doesn't change. I think we expect what you saw this year to broadly continue into next year. In other words, the fulcrum of this market will remain big tech, and the rest of the market will continue moving in that direction, but it will disappoint the market in terms of growth. For example, the consensus expects the rest of S&P's earnings to grow 11% next year. We think it's going to be about 3.5%.